Picture a man in his late 50s. It's 5 in the morning. He's sitting at his kitchen table next to a cold cup of coffee, reading every earnings report and tracking sector rotations across multiple color-coded spreadsheets. He is profoundly exhausted. And after all that effort, he has less money today than he did 3 years ago. It makes perfect sense why he's doing this. We are taught from childhood that effort equals reward. Put in the hours, get the raise. Train harder, run faster. And your career, and your relationships, and your health, discipline and hustle actually work. But building long-term wealth follows a different set of rules. Decades of data from rigorous academic institutions show a brutal pattern. The more frequently an individual investor trades, the worse their returns. Every time you react, check your app, or adjust your portfolio, you chip away at your own money. Researchers looking into the highest performing portfolios over long periods found something truly bizarre. The accounts with the absolute best returns belonged to people who had completely forgotten they had an account, or, in many cases, people who had died. This means the most effective strategy you can adopt is to do almost nothing. The stock market is the singular place in American life where the relentless pursuit of success, the sheer act of trying harder, actively destroys your wealth. Let's look at exactly how this happens. Consider two different approaches to the market. First, we have Dennis. Dennis earned a great salary throughout his career. He read the financial news daily, he moved his money to cash when he sensed a downturn, bought heavily into tech during the 2021 boom, and actively managed his positions. He worked hard at his finances. Then there's his sister, Margaret, a school administrator with no finance background. In 1989, she started putting a portion of her paycheck into a broad index fund. She completely ignored the news. When the market crashed in 2000 and again in 2008, she didn't react. She just kept working, kept contributing, and left the money alone. This dual-line graph illustrates their outcomes over the exact same time period. Dennis retired with less than $400,000. Margaret's steady, untouched account grew to over $1.2 million. The gap between them comes down to mathematical friction. Every single time Dennis made a trade, he paid a cost. Even without explicit commissions, he absorbed bid-ask spreads, the tiny difference between a buyer's price and a seller's. And when he sold at a gain held for under a year, he paid ordinary income tax rates instead of lower long-term capital gains. Compounding is the engine of wealth, and it works magically when left alone. A single dollar compounding at 10 annually for 40 years becomes $45. But if you interrupt that dollar every few years with tax events, trading fees, and bad timing decisions, that final payout is chopped down to $15 or $20. Margaret retired a millionaire because she understood wealth building is a waiting game. She won by stepping back and letting the system run. We are surrounded by a multi-trillion-dollar media ecosystem, engineered to make inaction feel dangerous. Every red arrow, every urgent notification, and every screaming headline is designed to provoke a reaction. Your anxiety is being monetized. The ultimate stress test for this behavior happened in March of 2020, as a completely unknown virus forced a global shutdown. Businesses closed, and millions of people were genuinely terrified for their lives and their savings. This chart shows the severity of the drop. In just 33 days, the market collapsed by 34%. It was the fastest crash in American history. Millions of panicked investors did what felt entirely logical. They sold everything and moved to cash to protect what they had left. But look at what happened next. From the bottom of that crash in late March, the S&P 500 went on to gain over 100% in the following 20 months. The people who fled to cash completely missed out on this recovery. And then came the double penalty. Those investors sat on the sidelines waiting for the news to feel safe again. By the time stability returned, the market was already up 60 or 70% from where they had sold. They were forced to buy back their own assets at significantly higher prices. The behaviors that systematically destroy your long-term wealth often disguise themselves as responsible risk management. Selling during a drop feels like cutting your losses, and moving to cash feels like protecting your family, making the trap almost impossible to see. Superior spreadsheets and insider knowledge matter far less than elite emotional control. To succeed, you have to develop the ability to sit quietly with your own discomfort. The actual math of getting wealthy is almost insultingly simple. You buy low-cost, broadly diversified index funds. You automate your contributions so the money leaves your checking account before you can think about it, and you check your portfolio at most once or twice a year. You have to build a plan that survives your own worst impulses. When the market drops, and it always will, the panicked version of you, staring at a red screen at 2 in the morning, should not be allowed to make financial decisions. You must lock in a strategy that protects your future wealth from your current fear. Active management carries a price tag that extends beyond your bank balance. It consumes the hours you could spend with your family and drains your mental bandwidth. Constant monitoring effectively turns your retirement plan into an exhausting, unpaid second job. The most successful investors rely on a single difficult strategy. They wait. Staying out of the way is the only proven method to capture the market's long-term upward trajectory.